for tuning into this earnings conversation with the management of Coforge. Not every IT company has managed to do this, which is surpass estimates, both on the revenue front as well as on the EBIT margin front. If anything, the commentary too has been confident but mixed. It'll be lovely to understand from Mr. Sudhir Singh of Coforge about how he thought the quarter went by was, and within the environment as it stands right now, is it possible to express definitive optimism for a space which is export oriented? Sudhir, thanks so much for taking the time out. Hope all is well.
Everything's fantastic, Neeraj. Thank you very much for the time and for offering this forum.
So can I start off with the revenue growth? It was, if I'm not wrong, in constant currency terms, about slightly over 6%, 6.2 sequentially. Was this something that you had anticipated at the start of the quarter? Is this in line with what you had hoped for? And how does this set you up for a quarter which is seasonally usually slightly weak?
6.2% is more or less in line with what we thought we wanted to land up with. Business leaders, all of us, tend to be a little greedy, so would have loved for that to be a little higher, closer to 7, but 6.2 is something we live with. We feel good about it. Quarter 3, you're right. Quarter 3, which is a quarter we're already in, is seasonally a weaker quarter with furloughs kicking in, especially for T&M projects, number of billable days going down. But given the order executable, which is the 12-month locked-in order book that we have at about $802 million, incidentally, the first time the firm has crossed $800 million, given the fact that last quarter we closed north of $300 million in terms of TCV, within the context of a seasonally weaker quarter, which is what quarter 3 should be, within those parameters, it should be a good quarter. Should be an okay quarter is how I would characterize it, looking at it from this point of view at this point in time.
Okay. I mean, this was what, the third straight quarter of that, if I can call it a landmark number of deal wins. And I would presume that it's order inflow and the execution which keeps these numbers going. In an environment which is increasingly looking, for lack of a better word, shaky, how confident are you of being able to, if not in quarter 3, but on a slightly longer term basis, continue the deal wins? What are client conversations telling you?
Yeah, so I think it's an interesting question, Neeraj. We have not had, if you look at Coforge, right, if you look at our profile, unlike a lot of our peers over the last 3 years, we have not had these standard positive tailwinds right through. Because 1/3 of our revenue when the pandemic started came from the travel industry. Other industries saw a significant infusion of technology-led demand. We did not. So for us, the fact that there is a conversation around potential recessionary headwinds, the fact that the macroeconomic environment is somewhat uncertain, shaky, as you put it, is not something that we would sweat over too much. Like everybody else we do, but we wouldn't sweat over it too much because the last 3 years haven't really been a cakewalk for us. What was a vertical that was almost 30% of our revenues has come down to only 19% of our revenues, and yet we have continued to plow ahead and grow very, very strongly. Last year we grew 38%, as you know, organically that was about 24. So at this point in time, when we look at the world, when we look at a grounds up view of the demand that's coming in, our approach to life has been somewhat simple. Client relationships, the numbers tend to be, our preferences for the numbers to be limited, but for the relationships to be deep. We also have significant exposure. 3/4 of our revenue really comes only from 2 industries, financial services and travel. Now, travel is clearly on a rebound. We do not see it turning back given how much it had fallen, irrespective of what happens in the macro. So that's one place where we feel reasonably assured about what's happening. Financial services, again, interest rates going up. Everything that we see grounds up. I'm not going to talk about interest rates going up, banks making hopefully more profit coming down, etc. But grounds up conversation from the select list of clients where we like to think that our wallet share is material, the relationships are deep, so far shows that at least for these 2 industries, demand is going to be resilient. We also operate like every other player in some other industries where we do see those currents coming in. So retail, especially high street retail, elements of high tech, there is clear headwind building up. But the material verticals, material industries, from our point of view, we seem to be good for now.
Okay. So, well, in some fashion, it showed because the order intake, as we said, third consecutive quarter of $300 million wins. I believe in BFS, you signed two large deals as well. You just mentioned that travel is actually on a rebound like it probably has never been. My question is, do you reckon that the sweet spot on the order inflows could continue? And two, despite a seasonally weak quarter, do you reckon that external pressures on you therefore might be less and you might be able to perform as normally as you would have in a quarter three?
So, I don't want to jinx it, but if you look at the last 6 quarters, Neeraj, we've closed 650 million plus TCV deals. And that's been a step jump in terms of our, not just the velocity of large deals, but also the median size of large deals. One of these 650 million deals, incidentally, was a $105 million 4-year, 8-month contract. So the velocity has gone up, median size has gone up. Confidence in the future, therefore, despite the ambient noise around the macroeconomic environment, is high. Obviously, none of us is Teflon coated. If things do go south very materially, we'll have to pivot, we'll have to readjust, we'll have to figure out how to handle things. But if there's one thing that we've proven to ourselves, more to the market, it is the fact that we can pivot very, very fast. We saw, and I talked about this, we saw travel as a vertical falling from 30 to 19% almost overnight. And yet, even in that year, we grew as a firm. So I believe, we expect that we should be able to pivot fast in case things go south. And if things stay on the straight and narrow, then of course, given where the locked in order book is, things should be good here.
Okay. Where you are a bit of an anomaly, and I meant it in a positive sense, and please correct me if I'm wrong, is the operational metrics. Here, companies, while attrition rates are for select companies starting to come off, very few companies have delivered the operational metrics growth that you have. And not too many are talking about an expansion in that metric at the pace that you're talking about for quarter three and quarter four. What's behind this?
Well, Neeraj, 5 years back, even 4 years back, when we actually started taking our story to the street, talking about what we are focused on, the first slide that we used to put up, used to just say execution, execution, execution. And we used to put up 13 operating metrics. That was the first slide, no words. We'd say execution, execution, execution. We would put 13 metrics. Revenue was one of them, but only one of those 13. We said, listen, if we are going to set up a platform at Coforge of driving sustained robust growth and not robust growth for 1, 2, or 3 years and then fading away, we need to make sure that the entire paraphernalia, right, that entire platform has excellence when it comes to execution within the details itself. So for us, this quarter, you're absolutely right, has not just been a story of revenue having been robust. All metrics, client concentration, we are very atypical in the fact that there's no one client or two clients or a set of 3 clients that we're really very wedded to or reliant on. Offshore revenues, it's a very atypical story. 2 years back, and we were talking about this earlier, if you looked at Coforge, only 36% of our aggregate revenues came from India. What these large deals have done for us is interesting. It's not just the fact that they've allowed us to chug along comfortably and drive robust growth. Equally importantly, if not more importantly, they changed the structural margin profile of the firm itself. So each of the metrics, to your point, revenue, margin in our case, incidentally, again, that 190 bips improvement, only 10 bips has come from currency, unlike a lot of our peers. The remaining 180 has come because offshoring numbers continue to go up. Utilization number has gone up and yet is still low. So there is more that can be amped up on the margin front from there. And the fact that the campus hiring program, which we've talked about, where the number of campus graduates that we took last year was 6 times the number that we took just 2 years back, is also kicking in with force. So the way we're looking at it, Neeraj, all metrics, not just revenue for a particular quarter, are lining up well. Offshore contribution to aggregate revenue has gone up. That revenue tends to be obviously higher margin, but more importantly, also stickier. employee attrition is, I suspect, the lowest across the industry. I mean, one piece is saying 160 bips fell. More importantly, employee attrition is 16.4%. Pre-pandemic used to be 12%, so not very dissimilar. Utilization at 77.5%. We believe there's still a lot that more that we can extract there. And the campus hire program that we almost did not have 2 years back is really has really got into shape and is now contributing materially to margin. So you're right. Execution. 13 metrics. I talked about some of them over the last 2 or 3 minutes. All of them seem to be aligning well, and hopefully that's going to sustain us for the next 5 years as well.
Okay, so you reckon the uptick or the up numbers that you're talking about in the second half could be the new normal, ceteris paribus?
Difficult to say. The first half has been good, right? At this point in time, CC terms, we're growing almost 23% over the first half.
No, sorry, I just meant on the margins front.
So margins, I expect the margins to play out on the same lines as the margins played out last year. Okay. Last year, at the end of H1, our margin was 17.4%, and we ended the year for the full year at 18.7%, right? So Q3 and Q4 saw a material bump. This year, it seems to be playing out more or less on the same lines. At the end of the first half, we're again at 17.4%. Our guidance to the market is 18.5 to 19%, and we believe we'll deliver.
Okay. Most things looking good. The ROW business, I reckon, because of the India contraction, has seen a decline. Now, why? I mean, how has that happened? And is that a conscious thing because the other side of the business is growing, or are you looking to course correct that?
No, we're not going to course correct that, Neeraj. As we see it, it's actually a welcome move. India is now only about 2.7% of our aggregate revenues. This is a firm where 10 years back, 24% was India. So it's obviously cost us quite some on a Q1Q or a quarterly performance basis to keep cutting away India. But India is not going to be a focus growth geo for us now or in the future. We're okay with 2.7. Might nudge up to maybe 3.5, 4 at times, but India is not a place we focused on.
Okay. I'd like to wrap this with one question that I'm asking most companies, which is whether, and I know you kind of referred to this in the first answer, but I'm still trying to reiterate, whether client conversations, if not in travel, but in BFS, are indicative of they being choosy about where they would spend, or there is a set of your peers who are saying that instead of run the business, the transform the business spend is just so high and clients can't take the step or can't take the foot off the pedal. And therefore, this playbook of the West being in a slowdown/recessionary phase and its impact on Indian IT for their company, that is, might be materially different than how it is played out in the past. What's your sense?
So at this point in time, if we look at what we are picking up, clearly the leaders versus the laggards in the financial services sector from a client perspective have been performing fairly unusually. I mean, they've been going on reasonably divergent paths. The whole story around moving away from digitization to digitalization, which the banks are talking about, is holding so far. We like to think that even if things were to go south, the banks or the financial institutions or the tier one insurance carriers would not course correct. They might. So it's a little difficult to be a soothsayer and say that things will not work out as they have in the past in recessions. But so far, from my vantage, from the Coforge vantage, grounds up conversation, I'm not talking top down, grounds up conversation still indicates that there is going to be resilience, at least for the foreseeable future, all the way till this year and maybe even beyond.
That's optimism. Well, thanks, Sudhir. That's very interesting set of commentary, and like I said, your performance is in a ways similar to just very few companies, and in many ways pretty unique compared to the rest of the pack. Congratulations on a great quarter, and to you and your team and family, wishing you a very happy Diwali and a prosperous New Year.
Wish your family, your team, and you a very, very happy Diwali as well. Neeraj, look forward to being in touch as we discussed today.
Likewise, and viewers, thanks for tuning into this conversation with Coforge.